Hello, Mark Oswald from ADM Investor Services International, with a look at commodity prices, above all from the aspect that these are the markets which most people hope will actually have quite a major rally in the coming year. A lot of it obviously is demand dependent, but we've also had a fairly choppy ride here. We'll start off with my first chart, which is the Goldman Sachs Commodity Index. Notable for the fact that we obviously had a very, very sharp fall in the spring as the virus pandemic took hold, but we have rallied quite sharply. Nevertheless, that rally still leaves us some 8% off the level that we started the year on, so there would appear to be plenty more scope there for it to extend, particularly if we do have a recovery. And indeed, it remains about 20% below where we were back at the peak in 2018. The notable difference between the two, obviously, is the fact that back in 2018, we were in a strengthening dollar environment, which eventually aided the commodity rally along with the oil price. And this year, we've obviously been particularly in the second half of the year, with a weakening dollar, a trend which many people expect to continue. I think it will probably be a rather choppier ride, but one which will eminently have an impact on commodity prices. Oil prices is the second chart, WTI oil future. I've used the second month primarily to iron out that spike below zero. I think here, obviously, the key is going to be the demand recovery. But I think it's also well worth noting on that front that as much as the break-even price in production terms for a lot of the OPEC producers is actually quite low, particularly in the Gulf Cooperation Council countries, but their budget requirements need a much higher oil price, basically to meet the very extended budget deficits that they have been running because of COVID. So let's then turn our attention to gold. It had a very good, strong rally up until August. It's been in something of a downtrend since. For the chartists, basically that down channel is probably something they're looking at whether we're actually going to test it and break out. It definitely, as a hard asset with low cost of carry, is going to be something that people are watching very, very closely. The opportunity cost of holding gold is obviously very low now, thanks to low interest rates, and likely to remain low. So it should remain fairly popular choice, particularly if there is a lot more uncertainty, but not necessarily if there's a strong recovery. My fourth chart is copper. Copper obviously had a very, very strong rally this year, really quite remarkable. And we've now got to levels which we haven't seen in a particularly long time. I think the key here is obviously Chinese demand and also expected demand from infrastructure demand, infrastructure-related investment, and also everything to do with new energy. The really big question there is how much supply disruption will we continue to see in the key producers in Latin America due to COVID? If that is overcome, perhaps it may look a little bit overpriced at the current juncture. My last two charts are from the agricultural sector. The first one is soybeans, particularly notable for the fact that it's actually stretched up particularly strongly. A lot of the price movement higher in soybeans has been related to supply disruptions, above all in Argentina, the big supplier of soybean meal and soybean oil, and also by the recovery in the Chinese swine herd, so for feed-related demand. My final chart relates to sugar. One of the more unpopular commodities of recent years, and it's had a great recovery, but we are now in the hands of what sort of subsidies we will see from India. So there's a quick overview of what's been happening in commodities.